So, if you trade SPY options, you've probably noticed this, right?
Yeah.
Especially heading into Friday expiration.
Yeah.
Sometimes it feels, well, a bit mysterious.
Uh-huh. The market seems to just kind of hover or maybe get pulled towards certain prices in those last hours.
Exactly. And it's easy to wonder, what's really going on there. And you hear traders talking about something called max pain.
Yeah, that term gets thrown around a lot online.
It does, but honestly, it feels like it's often misunderstood. Is it like some kind of market voodoo, or is there actually something structural behind it that, beginner traders should understand?
That's a really great point. A lot of traders, especially newer ones, they hear max pain and they're just not sure. Is it noise? Is it something I should actually pay attention to?
Right.
And from our perspective, trading systematically, watching these markets day in, day out for years,
Yeah.
we've definitely seen how certain dynamics can influence price, especially as options get close to expiring.
So it's not like a crystal ball?
No, definitely not a crystal ball, but it's not entirely random either.
Okay. And that's really what we want to help you figure out today. What exactly is SPY max pain? Why is it particularly relevant for SPY maybe compared to other things you might trade? And how do we, as experienced traders here at AdvancedAutoTrades.com, how do we actually use it as a practical piece of information? Something to consider, not something you just blindly follow.
Right. Our goal here isn't to hand you some kind of magic predictive tool, because max pain by itself, it just isn't one, especially not when markets are choppy or volatile.
Okay.
Instead, we want to show you how understanding this concept, it can actually offer some genuine insight into potential market behavior, particularly during those quieter weeks.
Ah, right.
It's really about adding another layer to your trading knowledge, giving you a more maybe nuanced view of the forces that might be at play as expiration gets closer.
Got it. Okay, so let's start right at the beginning then. When people say max pain, what are they actually talking about?
Okay, so at its heart, max pain. It refers to the specific strike price. For a given expiration date, it's the strike where the largest number of open options contracts. And that's puts and calls combined.
Both puts and calls. Okay.
Yes, both combined. It's the price where most of those contracts would expire completely worthless.
Worthless. Worthless for who, though?
Ah, good question. Worthless for the option holders, the buyers.
Okay, the people who bought the puts or bought the calls.
Exactly. Think about every single options contract that's currently open for, say, this Friday's expiry. Max pain is that single price point where if SPY closed right there, the combined value of all those outstanding options would be at its absolute minimum.
Huh. So it literally represents the price that causes the most financial pain or loss to the option buyers.
Precisely. That's where the name comes from.
So, okay, if it's maximum pain for the buyers, naturally, that means it's probably the best price for the sellers.
Exactly. Think about the other side of the trade. The market makers, the big institutions, maybe other traders, the folks who originally sold those options.
They collected the premium up front.
Right. They got paid for taking on that risk.
Okay.
Now, if an option they sold expires out of the money, worthless for the buyer.
Then the seller just keeps the whole premium they collected.
Correct. They keep it all free and clear. So the max pain level, by definition, is the price where the maximum amount of that collected premium across all those open contracts effectively becomes pure profit for the sellers, because the options just expire with zero intrinsic value.
Wow. Okay, that's actually fascinating. The market might have this gravitational pull towards the spot where the option sellers collectively would be happiest.
That's one way to think about the theory, yeah.
So why is this concept talked about so much, specifically with SPY? I mean, SPY feels different than trading, say, options on Apple or something.
It really does.
Yeah.
And what makes SPY unique is just its sheer scale.
Yeah.
The liquidity.
Teach.
It is arguably the most actively traded security globally.
Mm-hmm.
Because of that, its options chain is, well, it's incredibly deep. It's dense. You have massive amounts of open interest spread across a huge range of strike prices.
Right. You look at the chain, especially for the weeklies, and you see hundreds of thousands, sometimes millions of contracts sitting there.
Exactly. And that concentration of open interest, it creates a different dynamic than you might see in, say, a less popular stocks options chain.
Okay.
So as expiration gets closer, especially thinking Thursday and Friday, the participants who are short those options, the sellers, often the dealers, the market makers, they have these big positions they need to manage.
They collected premium, but they also took on risk.
Absolutely. They took on delta risk, and maybe more importantly near expiry, gamma risk.
Delta and gamma risk. Okay, quick refresher for beginner.
Sure. So think of delta as how much the options price is expected to move for every $1 change in SPY itself. Pretty straightforward. Gamma. Gamma is how much that delta changes. It's the rate of change of delta. And as expiration gets really close, like hours away, gamma can just explode.
Meaning the delta changes super fast?
Super fast, even with small moves in SPY's price. And this makes managing large short option positions really sensitive, really tricky, potentially quite risky for those sellers.
Right. So if they sold calls at, say, 505 and puts down at 495 and the price is getting close to one of those, their exposure is jumping around like crazy.
Exactly right. So to manage this rapidly changing risk, especially their overall delta exposure across their whole book of options, these large players often need to buy or sell the underlying asset.
So buy or sell SPY shares or maybe SPY futures?
Correct. To try and stay delta neutral or at least keep their risk within acceptable parameters. Now, the theory here, and makes a lot of intuitive sense when you think about the mechanics, is that the collective hedging activity of all these large players who hold significant short positions across that dense option chain, that activity itself can create a kind of pull or a pinning effect around the strike price where their net risk is minimized or where the most positions expire worthless.
And that price often lines up with?
That price often aligns pretty closely with the calculated max pain level.
Ah, okay. So it's not necessarily some like shadowy figure in a back room pushing a button to force the price to max pain?
No. Probably not like that.
It's more like the combined effect of many large players all trying to manage their own risk related to these huge options positions concentrated at certain strikes.
Exactly.
And the max pain strike just happens to be a major focal point for that risk management.
That's a great way to put it. It's almost like an emergent property of managing huge exposures in a super liquid market right as time runs out.
Yeah.
The sheer volume in SPY's options makes this potential effect more noticeable than in, say, quieter markets.
Okay, this really brings us to the big question, doesn't it? And where I think a lot of the confusion comes in. Is max pain actually a predictive tool?
Right.
Can I just look up the max pain level on Friday morning and say, okay, SPY is closing there? Or is it just, financial astrology, something people chat about but doesn't really mean anything?
That is the million-dollar question, isn't it? And you'll find traders firmly in both camps. Some swear by it, others dismiss it as complete nonsense.
So where do you land? Based on your experience, the data you've seen at advancedautotrades.com.
We land somewhere in the middle, leaning towards it being useful information, but not predictive. It is absolutely, positively not a guaranteed signal. It's not a standalone prediction tool.
Right. If it were that easy.
If it were that simple, yeah, everyone would just look at that number, place their trade, and we'd all be retired on a beach somewhere. Trading just isn't that easy.
So what is it then, in practical terms?
What we've consistently observed, looking back at historical data, is that the max pain level tends to act more like a sticky zone.
A sticky zone. I like that.
Yeah, think of it like a magnet. Not necessarily a brick wall it has to hit, but a level that SPY's price sometimes seems to be drawn towards, or maybe just hovers near. But importantly, this effect seems most pronounced under specific market conditions.
Okay, what conditions make that sticky zone effect more likely?
Well, in our tracking and analysis, we've seen this pattern show up most clearly when the market isn't being completely dominated by some huge macro event.
Like a surprise Fed decision or a big inflation print or some geopolitical shock.
Exactly. In weeks without those major catalysts driving the bus. And crucially, when implied volatility is relatively low.
Meaning the market isn't pricing in big expected moves.
Right. Low IV rank, for instance. In those kinds of weeks, the price action often does appear to sort of gravitate towards that calculated max pain strike as Friday expiration gets closer and closer.
Okay. So a potential area of attraction, a sticky zone, especially in calmer markets, but definitely not a certainty. That distinction feels really important.
It's critical.
So how often does it actually happen? How often does SPY really end up closing near this max pain level?
We've crunched the numbers on past expirations, specifically looking at those calmer periods we talked about. Now, it's certainly not every single week, but we've observed SPY closing within, say, plus or minus 1 or maybe 2 points of the calculated max pain level, roughly 40% to 50% of the time during those quiet weeks.
40 to 50%. Okay, so that's not 100%, obviously.
Not even close.
But it's also not like 5% or 10%. That's a meaningful enough frequency, wouldn't you say? Enough to warrant paying attention to that level as a potential area of influence.
That's exactly how we view it. It tells you that while it's not deterministic, it's not going to happen, it's also probably not just purely random noise either.
Right.
It suggests there might be some underlying mechanics, like those hedging flows we discussed, that create this tendency often enough that you probably shouldn't just completely ignore it.
Okay. So, given that it's not a crystal ball, how should traders, especially beginners, actually use this max pain concept? How do you incorporate it practically at advancedautotrades.com? What are the best practices here?
Right. The absolute crucial takeaway here, and I really want to stress this, is that max pain is best used as a filter, or maybe an informational tool.
Or input.
Exactly. It's an input into your overall analysis. It is absolutely not your primary strategy driver.
Right.
You don't build a trading strategy solely around trying to trade towards max pain or fade moves away from it.
Okay, so the message is not max pain is calculated at 500, therefore I should buy the 500 calls or sell the 500 puts.
Absolutely not. That would be treating it like a prediction, which, as we said, it isn't reliably. A much, much better approach is to think in terms of potential price zones around that max pain level.
Zones, not exact points.
Precisely. Don't expect an exact price pin down to the penny. If max pain is calculated at, say, 500, maybe you start thinking about the 499 to 501 area, or maybe even a slightly wider band, like 498 to 502, as a potential zone where price might congregate or be attracted to, again, especially on a quiet week near expiration.
This sounds incredibly relevant for anyone who sells options premium, trading strategies like iron condors, credit spreads, maybe even straddles or strangles.
Oh, it's vital. And this is something we definitely integrate into our systematic approach for strategies like that. When you're selling options, particularly strategies that involve selling strikes relatively close to the current price, like an iron condor or maybe a short strangle, we strongly, strongly recommend against placing your short option strikes directly at the calculated max pain level.
Wait, why? That sounds counterintuitive. If max pain is where options are most likely to expire worthless, wouldn't you want your short strikes right there to collect the premium?
Logically, yes, it seems like that would be the spot. But remember the sticky zone idea and think about gamma.
Gamma again.
Yep. If SPY does get drawn right towards that max pain level, or even worse, pins very close to it in the final minutes, those short options right at that strike become extremely sensitive.
Because gamma is highest right at the money near expiration.
Exactly. Gamma explodes at the strike as time decays to zero. So if you sold the 500 call on the 500 put, and SPY is trading exactly at 500 right before the close, both of those options have monstrous gamma. A tiny little wiggle up makes the call go slightly in the money, the put goes slightly out, and your overall delta exposure for the position can swing wildly almost instantly.
Wow, so you have literally zero room for error if it actually lands right on your short strike.
Precisely. It leaves you incredibly exposed to potentially rapid, hard-to-manage delta swings right at the most volatile time from a gamma perspective. It's just not worth the risk in our view.
So what's the alternative then?
We much prefer building a wider wing or buffer zone around that potential sticky zone. So if max pain is 500, instead of selling the 500-500 straddle or putting your iron condor short strikes right at 500, maybe you sell the 498 put and the 502 call as your short strikes in an iron condor.
Okay, give yourself a couple of the points on either side.
Right. Or maybe even wider, like the 495 put and the 505 call in a strangle, depending on volatility and your risk tolerance. That gives you a cushion, a buffer zone around that potential pinning area. It provides some breathing room against those last-minute price wiggles and that nasty gamma risk right at the strike.
That makes a ton of sense. You're acknowledging the potential influence of the level, but you're actively managing the risk around it. Smart.
That's the goal. Risk management first.
So how else should someone integrate this? Should they just look at the max pain number in isolation?
Well, absolutely not. That would be a mistake. Max pain is definitely most useful when you combine it with other pieces of analysis.
Like what?
Well, definitely look at the implied volatility rank, or 5E rank, for SPY. That tells you if the options market is currently pricing in high or low expected future movement compared to its own recent history.
And how does that relate?
If 5E rank is really high, it suggests a volatile environment. The market's expecting potentially big moves, maybe driven by news or uncertainty. In that case, those larger forces are more likely to dominate price action, and that potential max pain pull might be much less relevant or completely overwhelmed.
Okay.
But if IV rank is low, things are calm, the market isn't expecting fireworks. That's when the sticky zone concept might be more applicable. The underlying hedging flows might have more influence relative to other factors.
Got it. And should you also look at other open interest levels, not just the max pain strike?
Yes, definitely. Look at the total open interest, not just at the single max pain strike, but scan across the entire options chain for that expiration date. Where are the really big clusters of open interest, both puts and calls?
Other big towers of contracts on the chain.
Exactly. These other large OI clusters represent price levels where significant amounts of premium were also exchanged, where lots of positions were initiated. These levels can also act as potential support or resistance zones or areas where hedging might occur.
So you compare max pain to these other big OI levels.
Yes. Comparing the calculated max pain level to these other major OI clusters gives you a much fuller picture of where the big money positions are concentrated and where potential price interaction points might lie.
And I'm guessing the max pain level itself isn't set in stone for the week. Open interest changes, right?
It absolutely does change. Every day,
Yeah.
traders are opening new positions, closing old ones. That distribution of open interest across all the different strikes shifts constantly.
So the number you see on Monday might be different by Thursday.
Very likely. So it's definitely not a static number you calculate once and forget about.
Yeah.
You really should recheck the calculated max pain level midweek. Maybe Wednesday or Thursday morning is usually a good time as expiration gets closer and the open interest picture for that specific week becomes clearer and more settled.
Okay, good tip. Now, you also hear people talk about the put-call ratio quite a bit. How is max pain different from the put-call ratio? They both relate to options.
They do, but they're measuring fundamentally different things and serving different purposes in analysis.
Okay.
Max pain, as we've discussed, is all about identifying a specific strike price. It's pinpointing that one level where the combined open interest, puts and calls, would suffer the most financial pain if price landed right there at expiry.
So it's about a price level derived from where the positions are sitting, the open interest distribution?
Exactly. It's mapping the landscape of OI to find a potential magnetic point. The put-call ratio, on the other hand, that's generally used as a measure of overall market sentiment.
Sentiment, okay. How so?
It's typically calculated based on trading volume, although sometimes you see it based on open interest too. It's simply the total number of put contracts traded divided by the total number of call contracts traded over a specific period, usually a single day.
Puts divided by calls. And what does that ratio tell you?
Well, a high put-call ratio, say, well above 1.0 means significantly more put volume was traded than call volume. This is often interpreted as potentially bearish sentiment. Traders might be buying puts for downside protection or speculating on a drop or maybe selling calls more aggressively.
And a low ratio, below 1.0.
A low ratio suggests more call volume relative to put volume. That could indicate potentially bullish sentiment traders buying calls, maybe selling puts. It gives you a sort of broad feel for whether participants, on balance, are positioning more defensively or more aggressively.
But it doesn't give you a specific price target.
Exactly. It doesn't pinpoint a specific price level like max pain attempts to. It's more of a general mood indicator for the options market.
Got it. Okay, that makes sense. One is about a specific price point based on where options are open, OII. The other is a general barometer of market mood based on what's being traded recently, volume. Using both gives you different perspectives.
Precisely. And we believe it's beneficial to look at both. Use the put-call ratio for some overall sentiment context, and then look at max pain for a specific potential sticky price zone, especially, again, on those quieter weeks near expiration. Neither one is a crystal ball on its own.
Right.
But they are both potentially valuable inputs for your overall analysis and decision-making process.
Okay, so for beginner traders listening who want to start incorporating this, maybe start tracking it, where can they actually find the calculated SPY max pain level? Is it easy to get?
Yeah, fortunately, there are several resources available. A number of financial websites like Market Chameleon or Bar Chart, for example, they often publish the calculated max pain levels for major indexes and ETFs like SPY. They do the sort of heavy lifting of crunching the OI numbers for you.
Okay, so you can look it up on those kinds of sites. What if you're using a trading platform?
If you're using one of the more robust broker platforms, think Thinkorswim from TD Ameritrade Schwab, or Interactive Brokers TWS, you can often dive into the options chain data yourself. You can usually see the total open interest listed right there for every single strike price for any given expiration.
And you could calculate it yourself.
You absolutely could. You basically have to find the strike price where the sum of the put open interest and the call open interest is the highest number on the chain for that date. That's essentially the kind of data analysis we leverage in building our own systems at advancedautotrades.com, just automated.
Gotcha. Okay, so to kind of wrap this all up then, if there's one single most important takeaway about SPY max pain for beginner options traders listening right now, what would it be?
I think the key message, the absolute main point, is that SPY max pain is not some kind of magical, infallible predictor of where the market is going to close on Friday. You absolutely cannot rely on it as your sole directional signal.
Don't bet the farm on it.
Please don't. However, it's also probably not just random noise that you should completely ignore either.
It's a piece of the puzzle.
Exactly. It's a useful piece of information, especially for beginner traders trying to understand market dynamics. When it's used with the proper context, you absolutely must combine it with other analysis.
Like implied vol market environment.
Overall market environment, other key open interest clusters, your own charting, whatever else you use. And critically, it has to be integrated into a disciplined trading approach that includes sound risk management.
Thinking in zones, giving yourself that buffer.
Thinking in terms of price zones, not exact pins, and giving yourself room around those potentially sensitive levels, especially if you're selling options near the money.
So it sounds like understanding max pain is really about gaining a potentially subtle edge. It's about getting some insight into where these large pools of open interest exist and how the necessary risk management activities of those large players could potentially influence price action.
Yes.
Particularly on those calmer weeks as expiration draws near. That's precisely it. It's about trying to understand those potential underlying market mechanics, the plumbing of the options market near expiry, and then incorporating that understanding into your decision-making, especially around strike selection and managing your risk when you're selling premium.
Okay, so here's maybe something for you, the listener, to consider as you refine your own options trading approach. How could thinking about these potential sticky zones, like the max pain level, influence where you choose to place your strike prices, particularly on shorter-term trades expiring this week? How could that awareness maybe help you better manage that tricky gamma risk near expiry and potentially improve your overall edge? Something to chew on.